The real principle I want to share with you today is that, when you're paying for information in the markets, use it. Okay, now what I mean by that is it's a lot to do with something similar, which you find quite a lot in poker. Okay, if you're someone who's played a bit of poker, you would have heard this concept before, where the game of poker in essence is not it's not actually about the cards you dealt. A lot of people seem to think that the only way to win at poker is to play the cards you dealt. Yes, of course the card you dealt is important, but what's more important is how you manage to extract information from the players around you. Okay, because remember, you're ultimately playing your cards against everyone else's cards. All right, so in essence, what we mean by that is when you're playing around a poker, or when you're involved in a poker game, the objective is to ensure that every time you make a call, every time it comes back around to you effectively to make a decision, you have to effectively make one of two decisions. Either you fold, in which you no longer want to be in the hand, or you make a play that gives you certain information. Okay, what we mean by that is, if you decide to now do something in poker, whether it's you raise, you call, whatever it might be, whatever decision you make is going to elicit a response from the other players around the table. Okay, and it's that response, that information that you're trying to extract. Okay, because depending on how you bet is depending on the type of information you're going to get. Okay, and it's very, very similar in trading. Trading is so similar. In essence, a lot of the time we think, oh, we just sit there and, when A equals B, we just do C, and that's how it works. It's not as much as that, guys. There's a lot more nuance to trading, where you have to learn to interpret the information coming to you. Okay, more importantly, when you're executing trades, whether that's entering, whether that's exiting, whether that's taking profits, the moment you're engaging with the market, you're being given information, you're paying for information. Alright, so it's important to take that information and do what you can with it. Okay, use that information and make sure you capitalize on it. Now, I'm going to show you what I mean. I'm going to show you how this plays out effectively in the example provided. So it's that concept of, sometimes you have to take kind of 5 small losers. Okay, you often hear of good traders, you often hear them talking about feeling the markets out, feeling, what does the bid feel like, feeling what the offer feels like. Sometimes you have to take a few small losers and then ultimately lock in that big winner. Okay, our objective as traders is to make sure that when there's a big opportunity, okay, when there's an opportunity where the odds are in our favor, we're able to capitalize and take advantage of that opportunity. Okay, when they're not, what do? We take the small losers, we pay for information. Okay, so the example we're going to talk about is the gold. It's from the 23rd of October, and I'm going to show you how this played out in essence. Now, the first thing to do is just to go back to the candlestick chart, so you guys get a gist of what that looks like. Okay, so what we're looking at is the open drive. It's this segment here. This is now obviously a 15-minute a candlestick chart, and we're looking at this segment here. Okay, I'm just going to zoom this out so you can all get a little bit of a contextual feeling. So we can see the gold had been stuck inside almost 10 sessions, okay, stuck inside this obnoxious range between $22 and $36. So $14 range after a very aggressive breakout on the 10th of October. And we just sat in this range, and it began tightening and tightening and became somewhat more frustrating. Okay, now we're all aware that at some point this is going to crack. Okay, we're all aware that at some point, this is going to snap. Whether it's up or down, who knows? Okay, the important thing is we know the trend is to the upside, so we know there's a slightly higher chance it's going to move to the upside. Now, a good trader is someone that's, in essence, trading in here and they're buying in here. Okay, and they may be buying it in here again, and they may be buying it in here again. Why? Because obviously we're in an uptrend. The market seemingly every time it comes down gets bought up relatively easily, relatively easily, relatively easily, relatively easily. Okay, so a good trader is someone that's trying out things. He's constantly trying to be involved in the market based on what he thinks the pattern play might be. Okay, now every time he's playing, every time he's engaging, he's learning something. Okay, so if he bought it, he's learning, oh wow, okay, I went on side quite easily. There was a $10 rally, but the minute it hit this price point 36, my goodness, did it back off quickly. So he takes that information, i.e. it goes up quickly from lower prices, but once it hit a high price, it very quickly backed off and everyone took profits. Okay, similar thing, got to a low price, got bought up relatively quickly, and then very quickly backed off again, and bought up very quickly and very quickly backed off again. So straight away, a good trader is saying to himself, well, I can see that the best approach is to buy the dips and to sell the rallies. Okay, not the other way around, not Not look for levels, not try fade the market. Trade what he sees. Be objective, take the information and use that according to his strategy. Okay, so now what I want to get to is the whole point of I can't imagine too many traders would have made great money in this. Why? Well, because we're stuck in a range. Okay, you're going to win some, you're going to lose some. Net net, you should be up. Okay, net net, if you cotton onto this quick enough, you should be up overall. Right, but this is the juice. This is what we want. This is the real, spinach that's going to give you the, the oomph. Okay, and this is ultimately what you're paying for, guys. You're paying for this sudden shift. Okay, and this is what we call an open drive. I'm going to show you how it works. Okay, the most important aspect to an open drive, and the best way to illustrate this is with the footprint. Okay, the most important aspect to a open drive is two things. Number one, it's the volume. But more importantly, it's the sustained continuous volume. Okay, so it's not just there's a lot of volume over a 5-minute rotation. It's wow, there's a lot of volume. Oh wow, more. Oh wow, oh wow, oh wow. It keeps coming and coming and coming and coming. Okay, so the nature of an open drive is very, very high volume over a number of time frames, i.e. an hour, 2 hours, 3 hours. So it's sustained volume. Okay, because an open drive is big positions coming into the market at the open. Okay, so this is what it looked like. This is 7 o'clock. It's the open of the European session, and we can see straight away if you keep tabs of numbers, okay, you'll be very good at observing open drives. Right? If you don't, you won't. All right. Now, 2,000 contracts at 7 o'clock in the morning is extremely high for the gold. For it to then do 2,700 at 7:20, something's changed. Another 2,000, another 2,000, another 2,600, another 4,000. Okay, this is an absolute game changer. This should send all the signals, all the red flags off that something is in this market or someone is in this market. Okay, combined we almost did 20,000 contracts in a space of 40 minutes whilst Europe was just waking up. Okay, that was the real key. That was the real signal. Now we can see once the market did get to that sort of 4,000 volume, we got what they call an exhausted move. Okay, and you're going to see this. I'm going to show you this in the S&P as well. We tend to call this a stop run, okay, or an exhausted move. It's where the market hits a price point, okay, that there's just stops that get hit. And we can see those stops get hit by the zeros. So 0 by 94, 0 by 50, 0 by 40, 0 by 44. Okay, that's simply the stops. Now, when you see this, back off. Take your profit. Why? Because every other algorithm is going to take their profit. Right? And this is one of the strategies I teach quite extensively in the footprint course, is looking for those exhaustion highs and lows, and then more importantly, how to make money out of them. Okay, whenever I see exhaustion high and low, you will see me fading the market. Why? Because every algorithm is looking to take profit as well. All right. More importantly, once we take those exhaustion highs out, and we discuss this again in the footprint course, once they get taken out, it's very important to start paying attention. Why? Because if people were stopping out at this price point, when we go beyond that price point, in theory, there should be even more people stopping out, particularly if the market hasn't given them sufficient time or price to get out. Okay, we can see that obviously every one of these is a 5-minute rotation, and we can see that the market had barely 10 minutes to take a breather before that buying came in again. Okay, again, notice the volume, notice the consecutive volumes, right, and the market then went again. Now I just want to summarize that in terms of a chart so you can see kind of what we've done. Okay, so a lot of traders are looking at this and they go, oh yeah, but it was hard to get onto. Well, it's supposed to be hard. Okay, the whole point of an open drive is it's one big order comes to market on the open, and they don't want, or they won't allow the market to pull back because they have a very big order to fill. Okay, we can see that very, very aggressive market takes off from 12.27s all the way up to 12.35s, 70 tick rally, 35-40 minutes of consolidation, cannot pull back, shoots again, smaller pullback, shoots again. Okay, total range 26 is up to 43. It's almost a $20 range. Okay, guys. Now, the reason I share this lesson with you is because, one, I was the guy that was kind of struggling in this, not quite picking up on that information. I couldn't really come to terms with why am I not getting paid for being long every time. Okay, but the problem is I was buying it through the highs. I was being aggressive at the wrong area. Okay, but what I did make sure is I made sure that I didn't lose the information. Yes, I lost money being long with the highs, as you can see. Okay, but I didn't lose the information. So when this came, I managed to get back everything and a little bit extra. And that's the art of trading. It's pay for that information, just like a poker trader, just like anyone that wants to be skilled at what they do. They pay for information, and when that information matches ultimately what they're trying to achieve, then they push the lever, then they really get aggressive and take advantage. Okay, now the second little principle I want to share with you is I got asked a lot of questions about it. That's kind of why I want to share this. Is on Friday, it was just before, I think it was 6 p.m. I put this tweet out. Footprint says it all, the ESF. Okay, so E-mini S&P. That last move up was a bit of a stop run. Okay, how do I know that? It's not magic, guys. I promise you it's not magic. I'm going to show you what shows you it is a stop run. Okay, I said time to be short. Stop above the 93s. Why? Everyone thought that, wow, great call. It wasn't a great call. Okay, it was simply just using the odds in my favor. I'm going to show you what I mean by this. All right. Before I get to that, exhaustion stops. What is an exhaustion stop? It's very simple. Okay, an exhaustion stop is where the market runs out of energy. It's where, a market kind of hits a price point that stops are triggered. Okay. Now, the most important thing to understand about how to identify an exhaustion stop is the location. Okay, that's why I've got your location, location, location. Right, what we tend to see is that initiative takes place from a low price point. Okay, so if we see buyers initiating, they initiate from low price point. Right, so when you see a very, very aggressive, punchy up move, but at a high price point or at the end of an initiative move, that very often signals an exhaustion point. Why? Because we shouldn't be seeing initiative at the end of a trending move. We should be seeing it at the beginning of an initiative move. Okay. The second clue is liquidity. Very often what you'll get before exhaustion stops is someone provides liquidity. So you'll see a pocket of selling. It has one more push, stops up, comes back, and then reverses. Okay, the example we're going to use is the S&P 500 from the 26th of October. That is Friday. And like I've said, I'm going to show you how to use the odds in your favor. Okay. Now, I've been talking about this a lot over the last couple of weeks about, traders tend to want to sell prices and buy prices rather than just wait for someone who can actually move the market to sell it and then sell it. Okay, this is one of those perfect examples where if you had sold a price point, and I know this because guess what? I was that guy that sold the price point. Okay, I was short at 81, so I'm going to put a big fat red line there for you. Right? So I initially sold the 81s. I had a level there. Okay, something that I thought would really give me a good opportunity, and I sold it, and instantly, within a matter of seconds, I was trading 87s. Now you can imagine, as a leverage trader, futures, 6 handles offside, you do the maths, we're talking 24 to 30 ticks offside straight away. Okay, I was panicking, I was nervous as hell, I was so uncomfortable in the position. Right? So what did I do? I got out of the damn trade. Okay, I got out. Why? Because I'd recognized straight away that I was just picking a level, and I took the stop. I stopped out, and I took my punishment. I deserved the punishment because I'd sold randomly. Alright, so what I want to do is I just want to show you effectively the point I'm talking about, then show you the context so you can learn something. Alright, so this is the area that I sold, 81s. Market went up, and notice the delta, nice and positive. Okay, market comes back, tests those 81s, has a second go, notice the delta. Okay, now 4,500 delta on a 5-minute rotation is actually quite high. Now the important thing to understand before that 4,000 is what do we see happening once we sort of had this punch up to these 86s, 87s. Okay, we can see that someone actually sold. So the market went bid up quite aggressively to 87s, and someone sold it down. Not once, but twice. Okay, so someone effectively initiated shorts already once we got to that 87s, and that's the liquidity I'm showing you. Someone was a seller up there. Right, it's just that there was a more aggressive buy, and we see that buy comes up a second time, almost the highest delta on the day after an extreme rally. Okay, and this is what gave the clue that there was an exhaustion stop, or a stop run effectively. Right. More importantly, once we had that stop run, the very next rotation, what do we get? Same sellers entering, same sellers entering. Okay, so the very same sellers selling the 87s, there were some stops above them, and they started to sell it straight back down again. And that was our clue. That was just a stop run, and the sellers reinitiated after that provided liquidity just a couple of minutes ago. Okay, so let's put this into context. Right, where did the initiative start? Now, if you go back and you scroll onto your footprint from 5 o'clock, you'll see the initiative actually started down at 5 o'clock. And we rallied from 55s all the way up into 81s. That was at area of resistance, 81s. It then continued to 87s. Okay, brief pullback, tested the 81s, ramped one more time, took out the last stops, and then started to roll back over. Okay, so our initiative, guys, started at 56. It didn't start up here at 81s, and that's the mistake a lot of traders made. They would have seen this aggressiveness, they would have seen this delta and started to buy it up at 81s. forgetting that the move started at 56s. Initiative doesn't start at high prices, it starts at low prices. Okay, so I hope that makes a lot of sense to you guys. And the most important thing is to say is that yes, you're gonna make mistakes. Okay, you've just seen me illustrate two mistakes for you. One, I was buying gold at the highs all of last week. Wrong strategy. Okay, in the wrong conditions. Right? If it's a trending market, by all means, but it's a consolidating market. You saw me make a second mistake in the gold, selling blindly just because I have a level. But I took that information, I cut the trade, made sure I was objective again, and managed to get back on that short. And again, like I said, if I showed you the tweet, we were looking for a target of 48s. Like, yes, I took a 5-handle loss, okay, but you do the maths again. Decent 30, 40, 50 handle move back to the downside once I got in after the sellers had started to sell. Okay, so take the lessons, guys. I think the important thing to say is that we all make mistakes. Doesn't matter if you're amateur, professional. Just make sure when you make those mistakes and you're paying for information or education, make sure you learn from it. Don't waste that information. Make sure you capitalize on it when the time is right.